Wake up, buy here, pay here people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here, Pay Here Morning Show. Take it away, you two.
Hello, everybody.
Hey, good morning. Happy Monday before Thanksgiving.
Oh, yeah. It's, we were just talking with Steven, who's our guest backstage, and it's the week of Thanksgiving.
Mm-hmm.
So, it's like work will be at a minimum.
Yeah. Short
Lots of prep
for,
we're hosting this year for Thanksgiving.
For Thanksgiving dinner.
Thanksgiving dinner. And so, we're currently trying to figure out how many people are coming, because it's like usually neighbor, hey, do you want to come?
Yeah.
Hey, neighbor, do you want to come?
Mm-hmm.
So it'll be fun. I enjoy that kind of stuff an awful lot. So Jim's like, I enjoy it.
Yeah, I'll be there.
I'll be there.
You don't want me cooking.
So yeah, it'll be fun though, because
Yeah.
I've got all the kids coming to help the day before and get everything prepped. So
Mm-hmm.
what do we have? Any announcements?
No, in fact, I don't have confirmation on our one for Wednesday. We've got something up our sleeve to bring if our guest can't join us, but we'll nothing we can formally announce just yet.
Yeah,
so,
and likely Fridays will be recorded and played. So, because we'll be a family and
we have guests.
Stuff. We have guests. So, all righty. Anything else?
No, I don't think so. Let's jump in.
All right, we're gonna bring him in, Carsten.
Mr. Steven Carstens.
Welcome.
Good morning.
We're so glad to have you here and appreciate your expertise. Being willing to come and kind of give us a lowdown on what it is that you're seeing in the market.
So for those who don't know Steven, maybe we just start with a little bit of information about your background and your firm. You're in Texas, right?
Yep, Houston.
Uh-huh.
And the firm?
SGC is probably the oldest buy here, pay here firm in the country. Done it since the early 80s, exclusively buy here, pay here. Right. Originally founded by Ken Shilson, and then he retired in 2006. And it's been run by 4 other partners since.
Right.
And buy here, pay is all we do. And I'm an audit partner, and I've been with the firm 22 years.
So I asked you one time, so I know the answer, but for our listeners, your accent.
I'm South African, born and raised, and then I came here for college.
Which is okay. So you probably weren't exposed to buy here, pay here in South Africa, I'm guessing.
I was not. I was not.
Yeah, you learned.
Do they just not have it down there at all?
They might, but I was a teenager and wasn't looking to buy a car yet. So it's they might, but honestly, the dealership system is very different there. Everything's actually, even new cars are in ahead. There's nothing on the lots.
Yeah.
It's a different system.
Yeah. Wow.
Yeah. Something tells me though, there are lenders and borrowers just about everywhere. So
if you can make money, someone's going to do it.
Yeah. Someone figured it out. Right.
True that.
Yeah. So we're glad to have you here. I think I didn't explain a lot when I reached out to you that I had actually seen your comments on a thread, as we often do. We're in Facebook and we're in the same groups.
It was from a while ago.
Yeah, it's been ago, but somebody commented about, so a bulk buyer or somebody was looking to sell some paper in bulk, and you kind of chimed in on the conversation. It made me think, Steven's a guy who can definitely speak to this thing.
Yeah, it was also, I think that you made some comments about some of the bigger stuff closing down or squeezing. What it is that they're doing in lending. And so I was like, let's have Steven come. And Jim's like, let's have Steven come. And
we don't pay a lot of attention to the larger capital markets, as people describe them. We don't see a lot of news, frankly, but we also, obviously in our space, we see the things as it relates to subprime. And we've seen some of the same news you've seen about large dealership groups pulling out, some lenders deciding not to continue to engage in the space. And I personally was a dealer through the 2008 period. So we saw money come and go related to that big, kind of real estate driven thing. But now and one of the things I've always said, Steven, is like, in our buy here, pay here space, it always feels to me like regardless of what's happening in the stock market and the larger economy, like our buy here, pay here dealers are just kind of down here doing all the business they can afford to do. It doesn't seem to affect them a lot, except for the cost of money, which was one of the things. So what are you kind of seeing in the news, and what's the outlook for cost of money and just kind of a larger access to capital?
Yeah, it's tough in all industries. Since the crash of Silicon Bank, there's been a significant outflow of capital from the banks. And if banks, I think it's something like 3 trillion have left the major institutions. And so if they don't have deposit accounts, they won't make as many risky loans.
Gotcha.
So they'll make less loans because they don't have to provide returns on the deposit accounts.
Right.
So in all industries, even my partner, he's got some real estate investments, and even his real estate investments, the banks have told him they'll be changing the collateral requirements and making it harder for his loans. So even in real estate, which is a much more secure industry, they're tightening up and taking less risks. There's also been a lot of consolidation in the banking market. There's a lot less banks out there, which hurts when you try to get a loan. Unfortunately, a lot of in our industry, a lot of the lenders that would make loans joined together. So you went from 20 banks to 10 banks, and it's the same guys, unfortunately, but there's half as many options. So yeah, it's there's definitely been consolidation, less risky loans that they want to make, and the rates are way up.
I one of the things that just kind of sparked a question. So one of the big reasons you're seeing why banks are pulling back is because people are pulling their money out of the banks, and so it sounds to me like there's a good one of the good causes of this is because people are losing a little bit of their trust in leaving money in a bank. And so it's not as much a market driven of the vendors of the banks. This is more of a consumer driven towards the banks, and the banks are just trying to make sure that they can keep things moving forward in their institution. Is that correct?
It is, but funnily enough, with the rates of returns the way they are, you would think people would be putting money in, because you can now get 5% CDs, secured by the government in theory. But there's actually been a significant outflow. So I think people just lost confidence once some of those banks went, and the FDIC did actually cover the loans above the deposits above 250. Just to restore confidence. But people lost confidence, and money has been leaving for the entire year.
Yeah. And so, we've seen, and I kind of, we call it subprime. When I think about the way I learned it way back when I first got in the industry, was this idea of, credit scores kind of associated with like letter grades we would get in school. Like an A consumer is your top, tier consumer, high credit score. And then D has typically been reserved for the customer who we call as unbankable in the buy here, pay here space. So the interesting part for me to observe is kind of that C paper segment where you've got marginal credit consumers. And we know that lenders come in and out of that space, depending on the appetite of Wall Street, some of those kind of things. You see money kind of expand and contract into that zone, but it almost never comes into at least the Wall Street money almost never comes into the buy here, pay here space, right? I mean, we've got some providers out there doing some pretty unique things with securitizations and what have you. But I just wondered kind of what your perspective is on that. And maybe we can tie it to a second question, which is, what is the environment right now? Like, obviously we're coaches and advisors working with dealers, and we're hearing from quite a few people that recognize the opportunity that exists right now for buy here, pay here. And we're hearing from quite a few people who want to get in it. So I'm wondering what your perspective is on that from your chair as a CPA and specialist in the financial sector of the subprime business. Like, what are you seeing? Do you think this is a good time for dealers to be starting?
Not really. I think we're a couple of years out.
Yeah.
We have already heard announcements of banks that provide finance, or banks that do loans for new car dealers, pulling back. And in theory, that'll push some of that B and C paper that the new car dealers stole from us. It should push it down to us.
Right.
But it's not going to happen overnight. What's going to happen is the new car dealer will go find a different lender, and he'll get a little worse. The lender fees will be a little worse, but he'll still be in the money. and then that lender will go for 6 months, and then that lender will pull out, and then it'll be another lender, and at some point the deals no longer make sense to the new car dealer.
Sure.
And that's when those C grade paper, B grade paper will be pushed to us, because the new car dealer isn't going to do it anymore. But one bank pulling out, a couple banks pulling out isn't enough to immediately push that customer to us. There are always lenders that are ready to step in and take over that business until their economics no longer make sense. And but their economics don't make sense with the cost of their money and the rising default rates, and their margins are so thin that the people that buy the B and C paper from new car dealers, they actually pay a premium for that paper. And with the cost of their capital, and now default rates being the highest they've pretty much ever been, their economics no longer make sense. So they'll have to switch to discounting the paper, and then the new car dealer is not going to like that. And it'll take time, but that paper will trickle down to us. But it's probably 2 years out. I mean, when 08, 09 happened, we flourished in like 11 and 12. It takes time to come through to us. And I'm hoping in a couple of years the interest rates start to move back down again. Yeah. Because that hurts everybody.
So I want to come back to the idea of dealers who are just starting fresh in the business. Like, I want to know, as we think about kind of this business of, we know the environment currently is high cost of car. I mean, it's flattened some, it seems, but cost of car obviously moved dramatically in the last couple of years. And so that's been kind of an unprecedented, shift in prices, or certainly in a short time period. Then you've got higher cost of access to money for those dealers who might have the means to access external money. They're going to pay more for it, certainly in the near term. And so those things make it disadvantageous. We also recognize there's opportunity, but I saw a thing the other day, Steve, that said bankruptcies were up 17% year over year. So, that's an indication of, consumers struggling. And so I think it just feels like for those who, have the means to do it, that there should be plenty of opportunity, and that opportunity and the way you described it should only increase as far as those consumers who kind of fall into the unbankable category. Then we should be able to have greater increase. I just watch that, and I see we're seeing people who are moving forward. I think if they structure their business well, we're always advocates for walk before you run, mitigate risks through really good deal structure and financing structure. And so I think if we did that, we should see opportunity. But it's an interesting time. We're all just navigating. That's why I wanted to have the conversation with you. I think dealers out there are navigating this. What do they think? Is this a good time to go all in, or we're just kind of seeing different perspectives?
Yeah, and I wouldn't say go all in. Yeah. Maybe a good time to get your feet wet and get ready for 2 years from now.
Yeah.
Because everybody's contracting now. All the largest dealers are contracting. They've tightened up all their credit.
Sure.
But again, and they can flip the switch in a heartbeat to go back to aggressive growth. So, but a small guy starting out, you shouldn't have aggressive growth out the door. You'll make too many mistakes. Your procedures, your processes won't be in place. So if you want to get your feet wet now, conservatively, great, fine. But aggressive growth right now, no. But maybe, like I said, I do think it's coming. There will be these customers that get pushed down to our level, and then hopefully we can push out the 400s and move to the 500s,
right?
And that helps our overall business. That helps everything. So that's coming. That will come. And like you said, all the consumers are struggling, and that's going to push everybody down a notch.
Right.
And so we'll see the C's, which is what we're waiting for. But everything just lags so long in this industry. It's always a couple of years behind the news. So I think again, if you want to get your procedures and your processes and get some good employees, key employees in place, because it takes time to find key employees. Right. And just run a small conservative dealership for now and just wait around for that market shift. Absolutely. Mm-hmm. And honestly, my smallest dealers are consistently my most profitable dealers.
Interesting. Yep.
Yeah.
They always are. As in a percentage to what they sell, it's night and day. So keeping it small, getting a couple key employees, that's already a recipe for success. The larger you get, the more key employees you need, and it's harder and harder to find key employees. So yeah, I mean, a small dealership, I would never say no. Aggressive growth, I would discourage that right now. It doesn't make sense, and with the cost of capital, you likely have to borrow to finance that growth. Reconditioning, as much as any softening in the inventory costs have been replaced by increase in reconditioning costs. So we're still too deep into the cars.
Yeah.
So yeah, right now the economics are soft. So yeah, I mean, perfect your dealership, keep it conservative, and and just wait around for the market to change, because it's going to happen.
Mm-hmm. I have a couple of questions for you. It's kind of what I'm just wondering is if someone who has a lot of personal capital, that it would be a good time to get something like that started.
Wait,
because
are you saying you have a lot of personal
No,
capital?
I don't have a lot of personal
She's been holding
capital.
out on me.
Yeah.
She's saying someone who can self-finance the operation.
Someone who can self-finance the operation. And if there's a pulling back and other things, it's like this is an investment. If you're looking for something that's going to have a good return on investment, this is a good investment that's going to start returning in the next couple of years. You're going to start to see it really start to pick up and have some, is kind of what I'm hearing from what you're saying as well. It's like if you're looking for capital from a bank, maybe not as much.
There's the margins are too weak once you pay all that interest.
Yeah. If you've got the money, then it's like get yourself set up so that you can enjoy those benefits. I have a question, because this is how my mind works, and so I know, right?
Going inside her mind, Steven.
Franchise, they're constricting. So are they decreasing what they're producing for their inventory from the major manufacturers?
So they are, but so far we've only seen the high-end vehicles. There's been numbers of articles about these $100,000 pickup trucks just sitting, because no one can afford a $100,000 pickup truck anymore.
Right.
So they produce it there, and for a while they were actually selling them. Now they're not. So the high-end vehicles have definitely softened. People still need regular vehicles. So that'll take time to soften, and the demand's always there. It's just who's prepared to provide the financing to someone who's, your Kia and Hyundai have traditionally done your 500 credit score people, and they've had no problem doing that. How long till they do have a problem getting loans done for your 500 credit scores at a Kia and Hyundai? And then those are the customers that will be pushed down and start to have to shop used car. So we're waiting for that. But I mean, it's gonna take time. But the only softening we've seen so far is on high-end vehicles so far at the franchise dealers.
So what, like where this goes in my mind is if they aren't able to pick up the B and C paper, they're probably not going to be buying used vehicles, because the used vehicles are going to be your B and C paper people typically, which means that there's going to be more used vehicles that will be at the auctions, which means that what are the chances that the prices of used vehicles go down because now we have less buyers for used vehicles?
It will, and if new car inventory starts to stack up, then they're gonna have excess inventory and slow their buying anyway. So yeah, it all goes hand in hand. But again, it's 2 years. Everything takes time to. Inventory levels will have to build at the new car dealers. Then they'll slow their buying. then everything goes hand in hand, and it's going to be 2 years. It just will be.
Before you reach its peak of benefit, right?
Correct. Right now, all the economics, every single economic we care about is actually against us. Mm-hmm. Vehicles are high, interest is high, charge-offs are high, sure. Demand is mediocre. We're in this really, like, every economic thing is against us. But in 2 years, I'm hoping every one of them is actually moving in the positive direction. More demand, rates coming down, inventory softening. We could hit that sweet spot in a couple of years, because they all affect each other in a weird circle. So, sure. So anyways, it'll take time. It's not going to be next year. Yeah. And you always have a 2 or 3 year down period, and we're in a down period. Mm-hmm. And we've seen some of the worst financial results we've seen in a long time. And it's going to be, there's always a 2 or 3 year down period, and then 2 or 3 year great period. Yeah. So it just is what it is. So, be conservative and ride it out, and just try and keep your bottom line in the plus side. You ain't going to make millions right now, but keep it, as long as you can keep it in the plus side, that's all I ask of my dealers right now. There's the economics just are too tough to put down big numbers.
It's a good time to be working on efficiencies, get the operation streamlined.
Like you said, find your good key people if you're starting.
Oh, of course.
Like, it's really building something that's strong.
Systems.
Yeah.
Go to work systems. Get
and there are going to be dealers going out of business. We've heard about the big ones. I can tell you right now, we're aware of multiple dealers who are artificially covering their borrowing base, and they will be caught and they will be shut down. Yeah. And that'll put them out of business, and there's going to be key employees available. Yeah. And good time to pick them up, and if you have cycle through some employees that maybe are mediocre. I'm not trying to be mean, but you might have some employees that if the opportunity comes along, hire talent even if you don't need it right now, because
sure.
When you do need it, you're not going to find it. So if you see an opportunity come along, get the talent and get ready, because the market will turn. It always does. We've gone through these cycles, and again, I've been 22 years. It's probably the 5th or 6th up and down cycle that I've been through. And
so what I'm kind of hearing
is
if you're poising yourself for good talent, you're going to be getting a better customer and a lower priced car. So get ready.
We hope that's the plan. But just hang tight right now. You've got to make it through the next couple of years. And you got to keep your books in the plus.
Yeah, I've been hearing dealers say that for a while. It's like, get ready, because it's going to happen, because they've seen it before. It's like, get ready.
And one of the most common things that dealers have been saying to me is, and these are the old timers that have the really impressive operations, but they've been doing it 30 years. They're saying right now they're just like, it's just things are just back to 2019. And they're not wrong, because I'm in the middle of calculating everyone's new CECL allowance calculations, where I have to track their historical losses. And the losses are, we think that the losses are so bad, but actually they're just calculating back to about what they were in 2019. Good. The only difference is we didn't have high interest in 2019. So the losses are back to 2019, but the interest is way worse than 2019. That's why our economics aren't great right now. But the losses are just 2019 losses. So it's exactly. And unfortunately, some dealers haven't experienced those losses before. They started in the last 2-3 years, and so the charge-offs look bad to them, but they're just more normal charge-offs if you're an old-time dealer. So so you just got to work the economics, cut your expenses. Too many dealers have too much, there's a lot of fluff in their expenses.
Yeah.
And you just can't handle that right now.
Yeah.
The economics are too tight. You need to be cutting everywhere you can. And
getting smart with your money. I mean, if you're going to spend it, spend it in the way that you're going to get the best return on that money as you can.
Of course. I mean, it's too tough right now, too tight right now. Everything's too expensive. Look at every bill. Don't be afraid to renegotiate. Don't be afraid to question. I have clients who pay for like 5 or 6 different car websites to advertise their cars, and then and I really question, like, how many how many leads actually come from? You probably find 80% of the leads come from 3 of those 5, and those other 2, are probably bringing 1 or 2, and that customer probably would have stumbled upon you anyway once they switch to the other website.
Right.
And those are thousands of dollars. Each one of those websites costs thousands of dollars a month.
You can't measure. I mean, you can't look at something that you're not measuring, that you're not paying attention to. And so, start figuring out how to track what. Yeah,
it's too. You cannot be frivolous right now. With look at every bill, decide if that's really what you need right now, and try and cut your expenses, because we do everything as percentages, and interest is up as a percentage, charge-offs are up as a percentage. The only thing that we have control over is kind of our expenses. And if we have to, to stay profitable, we have to cut out of the expenses what we've lost on the interest and charge-off side, or else the economics no longer, otherwise you end up at minus at the bottom. So, we gotta keep the economics such that we end up with a plus at the bottom.
Yeah.
And, so it's funny because I recently got a large banker called me and asked me to come and do a presentation to his credit committee, because they were literally ready to jump off a cliff, and they were ready to burn this industry. And I went and did a presentation, and at the end I was just like, if a dealer is in the plus, I don't care if it's $1, and he's got availability on the line and he's not borrowing every single dollar on the line, that's an A customer. Leave him alone. As long as you can stay in the plus and keep availability, and you're not borrowed out every dollar, that's a healthy bank relationship. Dealers are simply not going to put down the numbers that they've put down the last couple of years. A dealer that might have made $750 and paid $500,000 in interest, if he does nothing different this year, he'll pay $1 million in interest and only make $250, and he hasn't changed anything, and it's not his fault. It just is what it is. So I told the credit committee, listen, as long as they got $1 on the bottom line and they've got availability on the line, that's probably a healthy dealer. Don't worry about him. Worry about the guys that are in the negative and have every dollar borrowed on every borrowing base. Unfortunately, that is a dealer who will likely run into a month where he can't cover the borrowing base, and he might do something. And that's once you and I want to stress to dealers, you might get caught in a tough position. Don't fudge the borrowing base.
Isn't that what we talked about when we look at our customers and we're underwriting our customers? When we create these really small margins of PTI, when they have a hiccup, which they're going to have a hiccup, then you're not getting paid. And it's the same thing as we need to be living by what we're preaching. Yes. To others.
And if you do run into that situation, talk to your banker. It's better to talk first and offer him a plan. Hey, listen, I'll pay an extra $50 for the next 3 months. I'm going to do this. I'm going to do this. Bankers are always, you have a better chance if you're upfront and offer him a solution. He almost won't have a choice but to accept your solution.
Right.
Versus if you do something like modify the accounts to show that they're still current, that next month now you're going to have twice as many accounts coming off, and you're definitely not going to cover it next month. And now you've just created you're walking the line of being shut down, right. And you'll lose everything. So you might run into a tough situation, but be honest with your banker. Come up with a plan for yourself. and I'm sure he'll be willing to work with you. The best dealers talk to their bankers. The bankers understand there will be tough times. Don't try to hide anything from your banker. It comes out in the wash in the long run. You cannot sustain a losing operation. Unfortunately, in the long run, it'll show up in the financials. It'll show up in your bank account. It'll show up in your cash needs. And you can only hide it for 2 or 3 months before it's over. So, just recognize if you have a tough situation, make a plan for yourself, communicate with your banker, and that's a bit, and that's a better way. And I actually think some dealers lie to themselves about how we'll just do it next month. Oh, I'll just, charge us will be better next month. And I don't think they're necessarily lying to the banker. They're lying to themselves.
Good.
And you got to recognize when things aren't working the way they are and the economics aren't quite there anymore. And you got to make a plan.
Well, a couple of things you talked about there that I think we can, one, I got to have you back a couple times. You touched on like this whole thing about small dealerships versus large dealerships and that whole scale. The whole, we would think economies of scale would work in favor of big operators, but I want to break that down when we come. I want to have you come back sometime.
I'm writing it down.
Rather than chasing that squirrel today. It's important. And then, you touched on kind of in the long run, which is, Michelle and I talk a lot about the long game. So this is kind of back to something we often talk about. In this case, we're talking about lenders, but whoever our providers are that we're working with, we want to make sure that they're playing the long game just like we are, because if we have misaligned interests, then that's going to make it challenging. If we have misaligned interests and we have a borrowing base or a leverage problem, then that really makes for an uncomfortable environment. But I think what I'm hearing you say, Steven, is like, we've been advocating for the same things. Communicate, be honest with yourself about your situation, and develop a plan, because we think, if you're really playing the long game and you really are in a position to weather a storm, then, you got to have a strategy to get there. You got to be working with somebody who's also playing the long game and prepared to go there with you, because we're seeing some lenders don't have the appetite. So it's important for us to know maybe not only where our lenders are, what they're charging, but also their source of money, so that we can better understand the appetite overall. But, it's tricky in that way. I would just say that one of the things that we see is that, dealers they're adaptive, but they just got to have a good strategy at this time. We've taken away a lot of the margin for error with costs of money. And so that just means we got to tighten up in the operation. We got to make sure our spending. And then the other conversation that I want to have with Steven one day is like, I hear you talk about those things, and I think you talk about the profitability and $1 to the bottom line. And I'm thinking about the cash flow side of their business, because there are a lot of dealers that are, they may be skirting the edge on their profitability, but they're in a cash position to weather the storm. Operationally, they may forecast to have enough cash to get to that 2-year mark that you're talking about. So I think the profitability, as we know in our business, profitability and cash flow are very different things. And some of our dealers see, at times that they do experience higher charge-offs. They experience also potentially a cash influx from the repossessed vehicle. So it's a question of how they manage those. Are they able?
Yeah, and you bring up a good point. If you're in a heavy leverage situation, contracting, even though it'll look bad on your financials initially, it's from a cash flow point of view, phenomenal.
Right.
Phenomenal. If you're used to selling 80 cars and you start selling 50 cars, that's 30 cars of cash that you're positive now every month. I'm a big fan of sometimes doing a contraction. Now, the expenses got to be cut simultaneously. You can't be paying like you were selling 80 cars in expenses. But if you're tight on your leverage, if your bank's giving you some trouble, and you are and you have a decent sized portfolio, shrink down, convert it back into cash. You'll be surprised how quickly it converts back into cash.
Wonderful advice.
6 months can generate millions.
If the money is high, then maybe let's use less of it. And of course, there was an incredible case study through COVID. We saw dealers contract very successfully, pay down debt.
Oh my gosh, yeah.
But the difference then was that consumers had money from the government. Now they don't have it. And so then their cost of groceries is higher and fuel is higher. So we're in a different time, but still the lesson that you're talking about still applies in terms of when we can contract and manage our cash. So I think that's what I would be taking to the lender, is both a profitability forecast and a cash flow forecast, to show them I have the means, from a cash perspective, to manage my way from here to there. And that's roughly the time period, Stephen, that we've been telling our own clients and been saying on the morning show. If we can develop a strategy to carry us 24 months, then we can catch our breath and the world will be different in 24 months. And
Absolutely.
so we can just,
of course.
let's just, get our way there, and then we can regroup and meet with the professionals and figure out where we go next.
We've got two topics that we're going to be bringing in the future. One is the small versus large, and the other one is profitability and the bottom line cash position to weather the storm by doing a little constricting.
Yeah. And and I just forgot what I was going to say.
Oh, that happens.
You're having a Michelle moment.
You don't have quite enough gray hair. It's worse.
We'll have you.
What I was going to say is, dealers also need to they do need to delever, because these banks are not going to do 65% advance rates anymore. Right. That's just not even feasible. They won't even do 60% advance rates.
Yeah.
We know that after 0809, banks got down as low as 50% advance rates. Mm-hmm. And I wouldn't be surprised if they head in that direction again. And that's because partly because a lot of banks now set their advance rates based on a CRR minus 10 or 15 points.
Mm-hmm.
And everyone's CRRs are heading in the wrong direction right now.
Mm-hmm.
So that'll automatically cut the advance rates. But also part of that is based on what paper sells for in the third party market, and that is softening.
Yeah.
Finance companies, their interest rates are through the roof. Their losses are up.
Yeah.
They're going to have to raise their discount rates to fix their model.
Yeah.
And so in turn, paper is softening.
Right.
And that in turn makes it less valuable to the banks. So the banks will lower their advance rate. So, I really think, everybody will be 55% in a year.
And that's not a bad thing for a dealer.
No, of course.
Yeah.
I'm a huge fan of less debt.
Yeah.
But it takes a bit of discipline to not borrow at 65 cents on every dollar. And maybe you got to sell 10 less cars to stay in a healthier cash position, and your growth will be a little slower in the long run. But I'm a fan of slow and steady versus fast and
you're
all the way up and then all the way down is what happens if you go too quickly.
Absolutely.
Yeah, Jim is like long game, and it's not just in customer relations, but it's just the long game that he keeps talking about. He's seen way too many dealers that hit this so fast, and it's like grow right off a cliff.
Yeah, I probably said that in articles 15 years ago, Steve. It's like you can race right off a cliff in this business. Like you can sell yourself out of capital, you can sell yourself out of, and obviously if we don't have good underwriting, and those things are improving, but I'm feeling like we probably all need to get other things done with our Monday. So I'm grateful for you making time to talk. We're going to have you back plenty, because there's so much. By the way, Stephen really breezed over something I don't think dealers hear. I certainly don't hear it enough, but it said that how the advance rate is typically arrived at based on collateral recovery rate, which means dealers need to know how to measure their own collateral recovery rate. We've done many shows on the subject in the past, but it's an important driver, and it kind of goes back to what I've always said. It's like it's the yield on the portfolio. At the end of the day, we all got to be able to squeeze enough cash out of our portfolios to make the thing work. And so, obviously you're a person who lives more on the financial side, the P&Ls and the profitability side. And we calculate P&Ls to the extent we need to know how much income tax we're going to have, but we're really working on the cash flow side of it more. So, it's just both parts are going to matter. It's really a lot of rich stuff to think about, but we're grateful for you taking time out of your Monday to talk about this. Some of the comments are coming in that they're grateful for
thank you. The
conversation. So we're going to have you back for some more. This is really important stuff to talk about.
Can you stick around after we close out the show so we can say a proper goodbye and kind of talk about when we can have you back?
Yeah, just stand by.
Excellent. Of course. Thanks again, Stephen. We really appreciate it.
No problems. Thanks, guys.
You bet.
All right.
Good stuff as expected.
Great stuff. And because sometimes I'm super straight line, and a lot of times I'm super squiggly line, because I come from customer service, and it's about like the intangibles and all of that. And what I am hearing is it is time for dealers to do exactly what they expect their consumers to do. And that's like, be communicative, take a look at your budgets, see where you can make a plan, and we'll work with you. And that's, we've had the conversation recently about the capital providers, and we had Russell Moore on, where his wife was like, wait, so we're complaining that the lenders are tightening up, but we're getting harsher on our collections as well. So it's like, let's just figure out how we can find this beautiful.
It's not hard. Just imagine, be a lender for a minute and say, if we're falling behind and there is no plan, I mean, what would be the outcome there? So it's like, we know that that's a way to get from here to there. So I think Steven touched on some really important points, and we're grateful for him making time. And so tune in again Wednesday. We'll let you know soon what our Wednesday topic is.
Hey guys, have a great Monday. It's Thanksgiving week. Enjoy the rest of your day, and we'll see you guys on Wednesday. Have a great day, guys.